Hey there. Let's get started with session 5 of the Startup Money Playbook series. And in this session, we will talk about fixed and variable costs and break even. Essentially, the question that we should ask in this session is how many units must you sell before you make a single rupee? The difference between costs that kill you and costs that scale with you, the break even formula every founder must know by heart, and what is the operating leverage? Why profit grows faster than revenue? But before that, let's quickly look at the recap. In the last session, we dealt with the cash flow statement. There were three sections in the cash flow statement, if you may recall: operating, investing, financing. The CFO, which was the operating cash flow, this is the engine health. The CFI, investing in future, and CFF, how you are funded. And each answers a different question. The second thing that we learned was depreciation is added back. It's a non-cash. The laptop example, if you may recall, that was purchased on day one, so the entire 50,000 was paid, but monthly depreciation reduces profit, but no cash leaves the account. Closing cash must equal balance sheet cash. So in case of study AI, the CFS that we saw was 46,63,843. That was a number that was used the last time in the balance sheet. Also the same numbers there. So if these don't match, there's an error. Now that we have the three financial statements, let's understand the cross structure that drives all the three. Okay, we're going to start with an example where the restaurant owner has 0 customers this month. And the question is, what does the restaurant owner still pay? Of course, then we will have a big split between the fixed and variable costs. Every cost in your business fits exactly one category. And you must learn to classify any cost in 10 seconds. Then there's something which is really important is the contribution margin, which acts as a benchmark. And this number tells that how much each sale contributes before fixed costs in. Then comes the break-even analysis. And this is very important because if you cross the break-even, that's where you start making profit. Units, revenue, and target profit, the three break-even calculations every founder needs. Of course, we are seeing all these things with respect to the study AI examples. So it is very clear that after this entire session, you will be able to classify any cost as fixed or variable. You will be able to calculate break even in units. Units means units of goods sold, and in rupees, of course. Then you'll be able to calculate the contribution margin. You'll be able to explain operating leverage and run three pricing scenarios. So here is the scenario. 0 customers, what still gets paid? The question that reveals everything about cost structure. So here is an example of Rajan's restaurant. And this is a scenario that happened in January month. So Rajan runs a mid-sized restaurant in Pune. The January was brutal. Cold snap, a festival elsewhere, a local competitor opening nearby. For the first 10 days, there were 0 customers, hardly any customer. But Rajan still paid the rent, which was a whopping 85,000 rupees. Of course, the chef's salary, 45,000 rupees. The helper's salary, 22,000 rupees. The electricity, which is the base amount, 8,000 rupees. And there was a loan that he might have taken. The EMI is 12,500 rupees. So the total that he had to pay was 1,72,000 rupees, due whether he served 0 or 1,000 customers. So the lesson that we learn from this case, these costs are fixed. They don't change based on how many customers walk in. 0 customers is still equal to 1,72,500 in case of Rajan. And if there are customers, great, but still he will have to pay. Some costs are linked to customers. For example, ingredients, electricity peak, takeaway packaging. These only happen when customers order. These are variable. The split determines survival. High fixed costs is equal to danger in bad months. And high variable costs is actually safer in bad months, but harder to scale. And every rupee you spend is either fixed or variable. There's no third category. Please remember this. And this is what we will actually study. Yes. So let's understand the fixed cost. Stay the same regardless of how much you sell. No change at all. 10 customers, 10,000 customers doesn't really matter, because these are the costs which you pay maybe for your rent, office space, and they don't change, of course. The founder or staff salaries, software subscriptions, loan EMIs, depreciation, these all remain fixed. But on the other hand, the variable costs, they change directly with the number of units sold. If there are no customers, of course, there is no variable cost. If there are 1,000 customers, you just multiply the cost of that unit, right, variable into 1,000. For example, payment gateway fees. Let's assume Razorpay takes 2%. So for every download, it will be rupees 2. Just recall the example that we have been taking, that is study AI. Hosting per extra user could be 0.5 per user. Raw material or packaging, for example, in this case, is per unit, right? If there are no orders, no takeaways, there's no packaging. Delivery cost, of course, per order. Then there's sales commission, percentage of sales. If there are no sales, no percentage. So the 10-second test is, if you sell 0 units, does the cost still exist? If it is yes, then it's fixed. If it is no, it's variable. Okay, let's take the example of study AI, month 6, and here every cost classified. Under the cost item, you have content production for the writer, and monthly, let's assume the writer takes 15,000 rupees. And the writer will be taking, irrespective of how many downloads happen or not. So this type of cost is fixed. And this is the operations part. The category is operations. The Razorpay gateway fees, which is 8,400. And this is variable. Okay, 7 rupees per download, 2% if you take, and which is revenue cost. So here the selling price was 99 rupees, if you may recall, and therefore the 7 rupees is coming. Okay. Then comes the hosting and infrastructure, 4,500 rupees. This is fixed, and the category is technology. Software and tools, again, it's fixed, it's operations. Marketing spend, this is variable. But in most cases, when you're at an early stage, there's a marketing budget that you decide, so which remains fixed. So let's assume that this is fixed for now, 12,000 rupees, and it's for growth. Depreciation, laptop, this is fixed because we've already paid that amount, and depreciation will be fixed. So 1,389 rupees. And there's a non-cash item. Then loan EMI and interest. Why have we mentioned interest? Because we are talking about the P&L in this case. So this is 612 rupees. This is also fixed. So this is finance. So what is the total fixed if you look at? It is 36,701. And there's only one variable, which is 8,400. Okay. So the part 3 of this session is contribution margin. This is the number that tells you how much each sale helps. This is the bridge between fixed costs and the profit. So let's understand how to calculate it. Contribution margin is very simple. You take the price per unit, and from that, you subtract the variable cost per unit. Okay. And if you have to calculate the contribution margin percentage, it's very simple. Calculate the contribution margin and divide by price per unit and multiply it by 100. And if you have to calculate the contribution, then it's very simple. Take the contribution margin per unit and multiply by the total units sold. Let's understand. Take the example of the study AI. The price per download is rupees 99, which is given, but the variable cost per download, and that is the 2% gateway, which is rupees 7. So the contribution margin per download will be 99 minus 7, which is 92 rupees. And contribution percentage is very simple. 92 divided by 99 into 100, which is 92.9%, closer to 93%. Downloads in month 6, so it's 1200. Actually, this is the number that we've been using for the past 4 sessions. So the total contribution will be very simple. 92 multiplied by 1200, that is 1,10,400. Total fixed cost is 36,701 from the previous cost table that we saw. So what's the net profit? The net profit is very simple. You take the total contribution, subtract it, the fixed cost from it, which is 36,700, and you get 73,699, which is before the interest and tax. Please remember, contribution margin is not the gross margin. Contribution margin subtracts only the variable cost. Gross margin, on the other hand, subtracts all costs, including fixed manufacturing costs as well. Part 4 of the session talks about the break-even analysis. And this is where, at heart, we want to make profit. So we want to know exactly at what point in time, as founders, we will be we'll have no loss, no profit situation, because once we cross that, every rupee that comes will be a profit for us. So how many units before you make a single rupee, right? So the answer every founder must know by heart. There are 3 formula again here. Break even, if you have to calculate in terms of units, simple. Take the fixed cost divided by contribution margin per unit. The fixed cost for study AI was 36,701. And if you divide it by 92, which is the contribution margin per unit, you get 399 downloads, which means if you sell, if Aryan sells, less than 399 downloads, it's a loss for him. But if he sells just above, let's assume 400, then he's actually making profit. And the contribution towards his business for 400 downloads is 92 rupees. Let's calculate break even in terms of revenue. You take the fixed cost and divide by contribution margin percentage. The percentage was very simple. We had already calculated. It was 92.9%. And here we get in rupees. That is 39,506, which means that if Aryan hits this number, 39,506, he'll be able to cover all costs. And if he achieves more than this, then there's always a clear profit. But if he achieves less, then he's at loss. So as founders, you may also decide to have a target profit. And the math can help you here. You take the fixed cost, put your target profit. Let's assume in case of Aryan, it's 50,000 rupees is what he aspires for. And you add both of them and divide by 92, which is the contribution margin. You get 942 downloads, which means you are taking a decision that if you start selling at least 942 units, you will definitely make a profit of 50,000 rupees. So these are just not numbers or math. These are tools for you to make decisions. Break even, comparison, 3 very different businesses. Let's take, for example, Ria's bookmarks. Price per unit is rupees 20. The variable cost is 4. So obviously the CM per unit, the contribution margin is 16. 20 minus 4. And the fixed cost, let's say it's 160. So which means the break even is 10 units, because you have to divide the fixed cost by CM. Similarly for study AI, I think it's very clear. The 399 downloads we've already calculated. Rajan's restaurant, let's take the average, price here is 350. The variable cost is 140. The CM is 210. Fixed cost is too high. We saw already. So 822, is what that he has to, cover. So if he doesn't make 822 orders, he will always be at loss. But if he targets 1,000 orders, he will always be at profit. There's something that you can do with your business that's called safety margin. Calculate that. Take the actual sales and subtract that actual. So you subtract your break even from this actual sale and divide by actual sale, right? So let's say your actual sale is 1,200 and your break even is 399, and if you divide by 1,200 you get something called 66.8%. This is the floor. This is the floor, and you have to always think beyond this, more than this, to be safe. Then comes part 5, which is operating leverage. Why profit grows faster than revenue. So let's take the operating leverage of Study AI. What you will observe from this table is revenue grows 8 times and profit grows 11 times. So when the downloads were 100, the revenue was 99,900, variable cost 700, because 7 multiplied by 100, and then gross profit is 9200. The fixed cost remains the same. There's a net profit that you see because the fixed cost is higher here, net profit. So there's no profit. In fact, it's a loss, 27,000. So it's minus. Just double the downloads. The net profit got reduced, but still it's negative, 18,301. But if the downloads became 399, the net profit is actually 7 rupees, which means it's a no loss, no profit situation. So hardly it's a profit, but it's of course not a loss. Mathematically, it's a profit. But once it is 600, there's a profit, 18,499. Once it is 1,200, in the 6th month, it is 73,699. So from minus 27,000 to plus 73,699. That's the story. So which means the revenue grows. So if the fixed cost stays what it is throughout, the revenue grows 12x and net profit grows from, minus 27501 to 7369. And this is an infinite figure that we actually saw. Okay. So above break even, every additional download will add 92 rupees. So we are taking just the example of Study AI, therefore we are using this figure directly to your profit. Okay. Fixed costs are already covered. So if it is below break even, every download helps chip away at fixed costs. And this is where the danger is. You need to actually cross it. So assuming that these are for Study AI from month 1 to month 6, month 3rd was where he actually achieved break even. Now, the 3 price scenarios. What happens if you change the price? Price, let's say, so look at the middle section. This is the base price, 99 rupees. Now let's reduce it by 10%. Okay, so when you reduce it by 10%, your price is 89 rupees. Okay, and your contribution margin per unit becomes 82 rupees by the same math. And the contribution margin percentage is 92.1% instead of 92.9%. So the break even, of course, is definitely higher. You need to have more downloads to achieve, which is 448. Here, the safety margin is 62.7%. So net profit, if you look at, is 61,699. Okay. So what this means is raises break even by 49 downloads. Profit drops by 12,000 rupees. Okay. You take the base case, the profit was 73,699. But as soon as you reduce the price by 10%, the profit reduced by 12,000 rupees. Avoid unless needed for market share. And just take the other case. If you just increase the price by 10%, what happens? Your break-even number reduces, that is 360, obviously, which means you achieve an early break-even. Your safety margin increases to 70% and net profit is 85,699, which means from 73,699, again, there's an increment of 12,000 rupees in the profit. So price is the most powerful break-even lever here. A 10% price increase at the same value adds 12,000 rupees per month to profit, which is equivalent to selling 130 extra downloads at the original price. No extra cost, just one decision what you to make. Let's understand the operating leverage principle again with another example. Why the movie theater gets rich after break even. So there's a cinema hall in Jaipur. The fixed cost includes the rent. Let's assume 3 lakh rupees per month. The staff salaries, 1,20,000 per month. Equipment maintenance, 25,000 per month. Electricity base, of course, it'll increase. So it's a base 40,000. There's a fixed one per month. There's a loan EMI 55,000 per month. So the total fixed cost is 5,40,000 rupees per month. The variable cost per ticket is rupees 20 because it depends on popcorn, cleaning, could be power per customer. But the price of the ticket is fixed, which is 220. So the contribution margin is 198, 220 minus 22. So the break even is 5,40,000 divided by 198, which is 2,727 tickets. To survive, to achieve the break even, this movie theater definitely must have to work hard to sell at least 2,727 tickets. At this point, there's no profit, not even the loss. But this is not a good figure. But what if from 2,722, at some point in time, 6,000 tickets are sold, house full? Look at the profit, 6,48,054 rupees. This is the operating leverage. Fixed costs don't change. Every rupee above break even, contribution margin goes straight to profit. So Study AI has the same structure, and which shows digital is better than everything else. Okay. 4 common mistakes what founders get wrong about costs. The first one is when they treat semi-variable costs at fixed. Okay. So the fix is very simple. Electricity, cloud hosting, and customer staff, support staff have a fixed base and a variable component. Split them properly or you break even will be wrong. The second mistake is missing founder salary from fixed cost. If you're not paying yourself, your break even is understated, and a market rate founder salary, even if deferred, or your cost structure is incomplete. Confusing CM percentage with gross margin percentage. So CM percentage excludes only variable costs. Okay. Gross margin, on the other hand, subtracts the cost of goods sold, which may include some fixed costs, manufacturing, and they're not the same number. The fourth mistake is setting break even as the target. Break even is just the floor. It's not the goal. We saw the movie example just now. The goal is to cross the break even as fast as possible and then scale the contribution margin. Every unit above break even is almost pure profit. So what you learned in this 30-35 minutes is every cost is either fixed or variable. And there's a 10-minute test that you can do. If you sell 0 units, does the cost still exist? If it exists, which means that's a fixed cost because they don't move. Variable costs scale with every unit. So which means if you don't sell anything and there are no costs, then in that case, it's a variable cost. Contribution margin is the engine. We saw the formula. Let's recall. It's price minus variable cost per unit. Every download contributes 92 rupees to covering Study AI's 36,701 fixed cost before making a rupee profit. The third one is break even tells you the minimum viable scale, which means if you know that you have to sell 399 downloads per month, and if you go below that, you will be at loss. And if you go above, and if you go significantly above it, you're making actually profit. So there's a safety margin that you already calculated, which is 66.8%. This is the floor. Please cross it. The operating leverage makes profit grow faster than revenue. Above break-even, fixed costs are covered. Every extra download adds 92 straight to the profit. We saw the example how the revenue from 12x right to profit from minus 27K to plus 74K. So the challenge for this week is you calculate your break even, run 3 scenarios. Okay. First one is the week's challenge. List every single cost in your business. If you have, classify each as fixed or variable using 10-second test. If you're a student and you get pocket money, just see what are the fixed and variable costs. Second one is add up your total fixed costs for the months. Calculate your contribution margin per unit. Calculate break-even units. Calculate break-even revenue. And run 3 scenarios. The cost, the current price, the 10% higher, the 10% lower. And which scenario changes your break-even most? There's a template 4T4, which you can actually download from the link in the description. Right. So cost register, you classify every cost. Break-even auto calculates in units and rupees. 3 scenario comparison table and the safety margin, which will automatically be calculated there. The tip of this week will be the fastest way to improve break-even is not to cut costs. There are situations when you need to cut costs, but that's not, at least at the early stage. It is to raise the price sometimes, okay? Even a 10% price increase at the same volume adds thousands to monthly profit with zero extra effort. Most founders underprice by 20 to 30%. Coming up next is a session on how to price anything. There are 4 frameworks that we'll study, right? That is, how are you going to charge? Is it like cost plus pricing or the value-based pricing, or there's something called competitive pricing or freemium and penetration? Session 5 is complete from my side. You can now go ahead and calculate the break-even for your business. Remember these, that every cost is either fixed or variable. There's no third category. And break-even to be considered as the floor. Cross it as fast as possible. Above break-even, operating leverage makes profit grow faster than revenue. Thank you very much for listening to me, watching. Do give your comments, feedback, and I'll see you in the next session.